This LOS is describe contingency provisions affecting the timing and/or nature of cash flows of fixed income securities and identify whether such provisions benefit the borrower or the lender. Bonds with contingency provisions. For bonds, the term embedded option refers to various contingency provisions found in the indenture. These contingency provisions provide the issuer or the bondholders the right, but not the obligation, to take some action. These rights are called options. These options are not independent of the bond and cannot be traded separately, hence the term embedded. Some common types of bonds with embedded options include callable bonds, puttable bonds, and convertible bonds. Options give the holder a right. Therefore, options have a price. Therefore, we need to look at who has that right. If two bonds are the same, except one has the right to be convertible by the holder, for example, the bond with the embedded option will be more expensive by the value of the embedded option because the holder has bought the bond and has bought the option. The higher price equals a lower yield. If the bond has the right to be called by the issuer, that means the issuer has paid the holder for that right, and the bond will be cheaper to buy to the holder than a plain vanilla. Bonds with contingency provisions. So now we're going to look at callable bonds, and you can see I put here in bold red, flashing red light. It's the issuer buys the right when it's callable. So the most widely used embedded option is the call provision. A callable bond gives the issuer the right to redeem all or part of the bond before the specified maturity date. The primary reason why issuers choose to issue callable bonds rather than non-callable bonds is to protect themselves against a decline in interest rates. This decline can come either from market interest rates falling or from the issuer's credit quality improving. If market interest rates fall or credit quality improves, the issuer of a callable bond has the right to replace an old expensive bond with a new cheaper bond issue. So available exercise styles on callable bonds include the following. 1. American style call, sometimes referred to as continuously callable, for which the issuer has the right to call a bond at any time, starting on the first call date. 2. European style call, for which the issuer has the right to call a bond only once on the call date. And finally, number 3, a Bermuda style call, for which the issuer has the right to call bonds on specified dates following the call protection period. These dates frequently correspond to coupon payment dates. Quick practice question to check our understanding. Which of the following provides the most flexibility for the bond issuer? A. Put provision, B. Call provision, or C. Sinking fund provision? Okay, the correct answer is B. A call provision allows the issuer to repurchase the bond for any reason, assuming the call deferral period has ended, and upon payment of any call premium. So A is not right. The put provision, that's flexibility for the bondholder, and a sinking fund provision is not the most flexibility because they require to retire a certain percentage of the bond over time. Another quick practice question. Which embedded option is most beneficial to a bond issuer? A. A conversion privilege, B. A floor on a floating rate bond, or C. An accelerated sinking fund provision? Okay, the correct answer is C. The accelerated sinking fund provision gives the issuer an option to retire more than the sinking fund requirement. So if interest rates were going down, they could retire more of the debt, or if they had more cash than they anticipated, they could retire more of the debt. So the other, you can get this one right though, because the other embedded options benefit the bondholders. So the conversion privilege, that benefits the bondholders. A floor on a floating rate bond, well, if interest rates are going down but there's a floor, that's going to benefit a bondholder. So the only correct answer in this one was C. An accelerated sinking fund provision is most beneficial to a bond issuer. Okay, this is perhaps a bit more of a difficult question, but let's have a look at it. When interest rates fall, the price of a callable bond will A. fall less than an option-free bond, B. rise less than an option-free bond, or C. rise more than an option-free bond? Okay, for this slide it'll get better once we've covered some of the derivatives, because when we cover derivatives we're going to see what the effect of interest rates are on certain options, and that's why I said this is a little bit tricky at first, but again, once you move through the material and cycle back, it gets easier. So B is correct, because when interest rates fall, the price of the embedded call option increases. Since the price of a callable bond equals the price of the option-free bond minus the price of the embedded call option, because that callable bond is a benefit to the issuer, the price of the callable bond will not increase as much as an option-free bond, since the price of the call option is increasing. As interest rates fall, the bond is more likely to be called, limiting the upside price increase potential. So recall, the issuer has the right to call, so they have paid the investor a premium for that right, which lowers the cost of the bond versus an option-free bond. So in summary, a lot there, but B is correct. When interest rates fall, the price of a callable bond will rise less than an option-free bond. Okay, this question should be fairly easy because it's the opposite of what we just looked at, and that's why it's the importance of reading the question so carefully, okay? So if market interest rates rise, in this case, the price of a callable bond compared to an otherwise identical option-free bond will most likely decrease by A, less than the option-free bond, B, more than the option-free bond, or C, the same amount as the option-free bond. The correct answer is A. A callable bond's value is equal to an option-free bond less the value of the call option. So as interest rates rise, the value of the call option decreases by a decreasing amount relative to the straight bond. The option-free bond also declines in value as interest rates rise, but this is offset by the decline in the value of the call option. Therefore, the price of a callable bond decreases by less than a comparable option-free bond. Okay? So these are a little bit tricky. You just basically have to do some memorization work to understand that if interest rates rise, then what's going to happen to the price of a callable bond, that most likely decrease by less than the option-free bond. Okay? Another quick practice question here. The most direct disadvantage of investing in a callable security relative to an otherwise identical option-free security is A, increased default risk, B, lower interest payments, or C, decreased price appreciation potential. I like this question. It makes you think a little bit. C is correct. The most direct disadvantage of investing in a callable security relative to an otherwise identical one is that the decreased price appreciation potential. We saw that in a previous question. When interest rates decline, more borrowers will prepay, limiting the potential for the bond price to increase. Okay? So continuing with bonds with contingency provisions, we're now looking at puttable bonds. And I put here in bold green, the bondholder buys the right. So a put provision gives the bondholders the right to sell the bond back to the issuer at a predetermined price on specified dates. Puttable bonds are beneficial for the bondholder by guaranteeing a pre-specified selling price at the redemption dates. If interest rates rise after the issue date, thus depressing the bond's price, the bondholders can put the bond back to the issuer and get cash. This cash can be reinvested in bonds that offer higher yields in line with the higher market interest rates. Because a put provision has value to the bondholders, the price of a puttable bond will be higher than the price of an otherwise similar bond issued without the put provision. Similarly, the yield on a bond with a put provision will be lower than the yield on an otherwise similar non-puttable bond. The lower yield compensates the issuer for the value of the put option to the investor. So we'll do a quick practice question to check our understanding. Which of the following is least likely to be a type of embedded option in a bond issue granted to bondholders? The right to A, put the issue, B, call the issue, or C, convert the issue. I think these questions should be getting a little bit easier, but you need to be careful with the least likely and the most likely, okay? So in this case, we're looking for the least likely to embedded option granted to the bondholder. So to put the issue, that's a benefit to the bondholder. To convert the issue, that's a benefit to the bondholder. To call the issue, as we saw, that's the benefit to the issuer. So the correct answer is B. So as I said, answer B is the correct because this type of embedded option is granted to the issuer, not the bondholder. And again, you can turn this question into true or false. Bondholders can put the issue, true. Bondholders can call the issue, false. Bondholders can convert the issue, true. Okay, so least likely you're looking for the false. Another practice question, all else equal, an increase in expected yield volatility is most likely to result in an increase in the price of A, puttable bond, B, callable bond, or C, option-free bond. Again, some of these questions will get easier when we cover the derivatives and then cycle back to the fixed income, because this is talking about the expected yield volatility and how it impacts an embedded option or an option in general. So it says, anyhow, the correct answer is A. An increase in expected yield volatility increases the price of an embedded option. So the price of a puttable bond will increase because the price of the puttable bond is equal to the price of an option-free bond plus the value of the put option. Okay? Because again, the puttable bond, that's a option that gives the holder, the bondholder, the right but not the obligation. Okay? So we're looking for an increase. So volatility increases the value of the option, and that'll increase the price of the puttable bond. The price of a puttable bond equals the price of an option-free bond plus the price of the embedded put option. A puttable bond is an option bought by the bondholder, so the price is the bond plus the option. It is sold by the issuer. So these are not too difficult with a bit more practice and a bit more covering the derivative section where we see what is the impact on options, yield volatility, or changes in interest rates, for example. Another practice question, holding all other factors constant, an increase in expected yield volatility will cause the price of A, puttable bonds to increase, B, callable bonds to decrease, or C, puttable bonds to decrease. Okay, you can see that this question was very similar to the last one. Practice makes perfect. And I just wanted to re-stress the point that the correct answer here is A. Increasing yield volatility increases the value of both put options and call options. And again, we'll see that later in derivatives, which increase the value of a puttable bond, which is long the put option, but decreases the value of a callable bond, which is short the call option. So you can see these are the formulas at the bottom, the two, and it's just very important that you understand this, that the price of a puttable bond equals the price of an option-free bond plus the price of an embedded put option. And the price of a callable bond equals the price of an option-free bond minus the price of embedded call option. So if you write out the formula like that and you go back to look at the question, increase in expected yield volatility, well, that's going to increase the price of the embedded put option. So then you can see what's happening to the price of the puttable bond. It's increasing it, but it's decreasing the price of a callable bond. So in these, don't do all the math in your head. Don't think them through all in your head. My advice is always write out the formula like you see it, the price of a puttable bond, option-free plus, callable, option-free minus, and then go back, look at the question because it's going to be most likely, least likely, increase, decrease, and work it out and make sure you select the correct answer. Another practice question, which of the following provides the most protection to a bond holder? A, call protection, B, refunding protection, or C, sinking fund protection? Okay, the correct answer is A. Call protection is a benefit to the bondholder. Call protection means the bond cannot be called from the bondholder by the issuer for any reason. So do you see that? It's not a callable bond, it's call protection, okay? Refunding protection, that's a benefit to the issuer, and a sinking fund protection, that's a benefit to the issuer as well. So continuing with bonds with contingency provisions, now we're going to look at convertible bonds. And a convertible bond is a hybrid security with both debt and equity features. It gives the bondholder the right to exchange the bond for a specified number of common shares in the issuing company. Thus, a convertible bond can be viewed as a combination of a straight bond, option-free bond, plus an embedded equity call option. Convertible bonds can also include additional provisions, the most common being a call provision. From the issuer's perspective, convertible bonds offer two main advantages. The first is reduced interest expense. Issuers are usually able to offer below market coupon rates because of investors' attraction to the conversion feature. The second advantage is the elimination of debt if the conversion option is exercised, but the conversion option is dilutive to existing shareholders. And we saw that back in the previous LOS with regards to convertible bonds and the impact on the earnings per share, you may recall. Okay, we're going to continue with the convertible bonds, and we're going to look at some key terms and some simple calculations regarding the conversion provision, including the following. So the first, the conversion price is the price per share at which the convertible bond can be converted into shares. Okay, that's the conversion price. The conversion ratio is the number of common shares that each bond can be converted into. So here's a simple example. The conversion ratio is equal to the par value divided by the conversion price. So for example, if the par value is 1,000 euros and the conversion price is 20 euros, then the conversion ratio is 1,000 euros divided by 20 euros equals 50 to 1, or 50 common shares per bond. Okay? So the conversion value, though, is sometimes called the parity value, is the current share price multiplied by the conversion ratio. So for example, if the current share price is 33 euros and the conversion ratio is 30 to 1, then the conversion value is 33 euros times 30 equals 990 euros. The conversion premium, you can see I've put that into catch your eye, is the difference between the convertible bond's price and its conversion value. So for example, if the convertible bond's price is 1,020 euros and the conversion value is 990 euros, the conversion premium is the 1,020 minus 990 equals 30 euros. So conversion parity occurs if the conversion value is equal to the convertible bond's price. Using the two previous examples, if the current share price is 34 euros instead of 33, then both the convertible bond's price and the conversion value are equal to 1,020 euros, i.e. a conversion premium equal to 0. This condition is referred to as parity. If the common share is selling for less than 34 euros, the condition is below parity. In contrast, if the common share is selling for more than 35 euros, the condition is above parity. Let's do a quick practice question on that to check our math. So assume that a convertible bond issued in South Korea has a par value of 1 million and is currently priced at 1,100,000. The underlying share price is 40,000 and the conversion ratio is 25 to 1. The conversion condition for this bond is A, parity, B, above parity, or C, below parity. Okay, you can see that this question is not too difficult, and that's why the more you practice, the easier these become. C is correct. The conversion value of the bond is the 40,000 times the 25. So you see that it's the 40,000, it's the underlying share price, and times the conversion ratio. And that's going to give you 1,000,001. You compare that, the price of the convertible bond is 1,100,000. Thus, the conversion value of the bond is less than the bond's price, and this condition is referred to as below parity. And one last practice question to finish this LOS. A portfolio of option-free bonds is least likely to be exposed to A, volatility risk, B, yield curve risk, or C, reinvestment risk. Okay, this was a nice question to end on because we talked a lot about volatility, etc. So a portfolio of option-free bonds is least likely to be exposed to volatility risk. The correct answer is A. Volatility risk is the risk that the price of a bond with an embedded option will decline when expected yield volatility changes. So by definition, option-free bonds are not affected by volatility risk. So a nice little question to end on, and that's the last slide for this LOS. Thank you.